You are one of the millions of Americans who, for one reason or another, have a balance due on your tax return, but you don't have the money to pay it on time. What happens now? Well, I'm here to tell you. I'm the Tax Geek with more of your taxes oversimplified. In this video, I'm going to tell you what options you have when you have a balance due that you can't pay right away. If you have a balance due on your tax return, you must pay the full balance due by the due date of the return to avoid penalties and interest. After that date, as long as you filed your return or an extension, your balance will grow at a rate of 0.5% per month, plus the IRS's current interest rate, which, as of the publication of this video, is 4% per year, but is subject to change. That 0.5% is called the failure to pay penalty, and cannot accumulate to more than 25% of the balance due. The interest compounds monthly, and is charged on the unpaid failure to pay penalty as well. Note that filing an extension will not give you more time to pay, only another 6 months to file. When you have a balance due on your return, it is extremely important to file the return even if you can't pay. The failure to file penalty is much higher at 5% of the balance due on the return per month plus interest. In just 5 months, your balance will grow by over 25%. So you owe, but you can't pay. What should you do? Well, let's start with what you shouldn't do. We already covered simply not filing the return. Burying your head in the sand is never a good strategy. Next, do not file and then ignore the balance due. The IRS will send ever more serious notices, and if you ignore them, will escalate from reminders, to demands, to placing liens on your property, to seizing part of your income stream by garnishing your wages or government payments, or in rare cases, actually seizing your property. I'll cover the IRS's collection process in detail in another video. Don't take money out of retirement accounts to pay your current balance due. You will owe income tax and most likely a penalty on the early retirement account withdrawal. This will create a vicious cycle, just adding to your tax burden in subsequent years. And finally, don't put the balance on a credit card. You might feel better receiving credit card bills rather than bills and notices from the IRS, but even considering the failure to pay penalty, the interest rate you'll pay to the IRS is lower than just about any credit card interest rate. So what are your options if you can't pay by the due date of the return? The IRS offers 2 types of payment plans. A short-term plan where you must pay off your balance due within 120 to 180 days, and a longer-term installment plan where you can pay off your tax debt over as many as 72 months. The short-term payment plan is easy to set up online through an IRS online account or by phone, and there is no charge to set it up. You can make periodic payments or a lump sum before the 180 days is up. If you need more time than 6 months to pay, you will have to set up a formal installment plan. You can set one up online using your irs.gov account, by calling the IRS, or by filing Form 9465 either with your tax return or separately. When requesting an installment plan, you take your total tax debt and divide it by 72 to arrive at a recommended amount. You then tell the IRS how much you can afford to pay monthly, what day of the month works best for you for payment, and how you'd like to pay. You can arrange to have the monthly payment automatically debited from your bank account, or you can tell them you'll be sending them monthly checks or paying directly online. If you can't afford the recommended amount, you may need to file Form 433F. This form gives the IRS your financial situation so they can evaluate it and approve a lower payment. There is a cost for setting up an installment plan. The fee is deducted from your first payment before it is applied to your tax debt. The fee is currently $31 if you agree to automatic monthly debit and you apply for the agreement online. The fee can be as much as $225 if you don't agree to automatic payments and apply for the agreement by phone or mail. These fees can be lowered or waived for certain low-income taxpayers. Unlike the short-term payment plan, which usually covers only the current year's balance due, the long-term installment plan can be used to consolidate several years of unpaid taxes. While the agreement is in effect, you must agree to file all future tax returns on time, and you must not have any unfiled past returns. Also, during the installment agreement, any tax refunds you may be due will be applied to your installment plan balance. If you default in your installment plan, the plan ends and the IRS will resume collection activity. You can have the plan reinstated by agreeing anew to the payments and paying an additional fee. With both the short-term and installment payment plans, penalties and interest will continue to accrue on the unpaid balance until it is paid in full. If you'd like additional details on IRS payment plans, there are links to resources in the video description. If you found this video informative, please give it a thumbs up. If you think someone else would find it useful, please share it with them. If you'd like to see more mini deep dives into our complicated tax system, please subscribe. And if you have additional questions, comments, or suggestions, please leave them in the comment space below. Thanks for watching, and stay tuned to this channel for more of your taxes oversimplified.